Can't decide between buying VTI versus VOO? Well, you're in luck because I'm going to make that decision easier for you. I'm going to go over how the funds differ, the reason why people like to invest in these two funds even when they're down, and I'll even tell you about some competitor funds that make good alternatives. Hi, I'm Nadia, one half of the Wealth Twins, and this video is meant to help you decide if you want to own either of these funds in your stock market portfolio. If that sounds good to you, hit the like button and let's get started. VTI is Vanguard's total stock market ETF fund. It was designed to invest in basically every publicly traded company that's available in the US. VTI is an ETF that tries to mirror the CRSP US Total Market Index. The CRSP US Total Market Index was created by the Center for Research and Security Prices. Vanguard decided to adopt this index and 15 other CRSP indexes as a benchmark for some of their ETFs. Currently, VTI invests in over 4,000 different companies ranging from micro cap to large cap. Now, market cap is the value of the shares a company has outstanding multiplied by the price per share. A micro cap company is less than $50 million and a large cap company is more than $10 billion, just to give you some background, okay? VOO, on the other hand, is Vanguard's S&P 500 ETF, and it uses the S&P 500 as its benchmark. It invests in only 500 large cap companies that are listed as part of the S&P. The S&P is a list of the largest companies in the US. If a company is not part of the S&P, then it cannot be part of VOO. These funds also differ in price. Right now, you can buy VTI for $183. That's off of its 52-week high of $244. While on the other hand, VOO is currently trading around $330 off of its 52-week high of $441. So if we're looking at it, the main differences between these two funds are the underlying investments of each fund and the price. Now let's jump into how they're similar. As mentioned earlier, both VTI and VOO are Vanguard's ETFs. Vanguard is known for providing low cost but good performing investment products. Both VTI and VOO are passively managed exchange traded funds that use a weighted system for allocation. Now, just in case you don't know what a passively managed ETF is, I'm going to explain it to you right now. A passively managed ETF or exchange traded fund means that there are no money managers that are actively picking and selling the companies that fund invests in. The fund just invests to mirror the benchmark that it was intended to track. Now, if you're looking to buy either VOO or VTI, or both of those ETFs, you can do so through a broker during the trading day, just like you would a regular stock. This is different from buying a mutual fund or index funds. Those can only be bought at the end of the day once the net asset value or the NAV of the fund is calculated. Now, if you have any questions about what the NAV is, let us know and we'll try to address that later. Well, when we look at both of these funds and we take a deeper look, we will see that VTI and VOO are very similar when it comes to their fees and their performance. Each fund has a low expense ratio, aka their fee, of a 0.03%. And although both funds are currently down over 20% in terms of their ROI year to date, if you look at their historical performance over the last 10 years, you will see that each has an annual return of over 12%. But we all know the saying that past performance does not predict future performance. But do not use that fact to say since these funds are down 20%, that's an indication that these are not high quality funds, okay? We believe these funds are performing poorly right now because of what both funds invest in and how much money they allocate to different types of businesses, which is also known as sectors. Both VTI and VOO use a weighted system when it comes to determining which companies and which sectors get most of their money. If you look at the weighted system that both funds use for allocation, they both invest in 11 different business sectors, and 25% of their holdings are in the tech sector, so they're pretty tech heavy, and tech is taking a beating right now. The companies they hold the most of are Apple, and that is followed by Microsoft. Now, some might say Apple's a good dividend-paying growth stock, and it's definitely a good company to have in your portfolio. However, if you see that their top holdings are basically all tech, then it's easy to see why these funds are down over 20% this year, okay? Now, if you've been watching the news, you know that overall the U.S. stock market is down compared to last year. This is due to a combination of things. Two of the biggest reasons why many people think it's down is due to the Federal Reserve raising rates and fear of a recession. However, tech stocks are the ones that have lost the most, and any fund like VTI or VOO that have a significant portion of their holdings in tech are losing big right now. Additionally, since both of these funds are huge and invest in all sectors and are not actively managed, they basically move in the direction of the market. On Vanguard's website, they provide a risk reward scale to show what can happen to your money when you invest in their funds. On a scale of 1 to 5, they rank VTI and VOO as 4s. And they note, and this is a quote, an investment in these funds can lose money over a short or even long period. You should expect the fund's share price and total return to fluctuate within a wide range, like fluctuations of the overall stock market. So you're probably wondering now, if these funds can fluctuate so much, why would anyone want to hold them, especially right now when the market is going up and down? Well, the reason why people invest in VOO and VTI is because there are broad based indices, exchange traded funds. You don't have to try to pick winners, you just buy one ETF and get access to many companies. This is diversification, and it makes it easier to manage your portfolio and still have a chance of participating in the upside of the market in a relatively low cost way. So, for the average investor, this works. If you believe the US economy and that US companies will remain leaders, it's a good idea to buy an ETF like VOO that invests in large companies in America. The S&P 500 is the index that many use to determine the health and direction of our economy. Similarly, if you want a chance to own a small piece of a company that might end up being a future industry leader, then VTI will give you a chance to do that without trying to figure out which company out of all the companies you can invest in right now will be the winner. You're taking a bet without putting all your chips on one option. Now, both of these funds provide diversification with a higher possibility of getting close to the returns of the benchmark index for someone looking to invest in this manner. You would also look to invest in funds like this if you believe that passively managed funds perform better than actively managed funds. If you look at the data, the reason why Vanguard created index funds in the first place is that they understood that it's very hard for actively managed funds to beat the market. So instead of trying to beat the market, it's better to try to just match it. Now remember, not everyone sees the stock market being down as a bad thing. Remember, I said the 52-week high of VTI was $244, and for VOO, it was $441. If you're a long-term investor like me and don't care about the daily market going up and down, you would see these ETFs as being on sale right now and will pick them up for basically half the price. If you're still debating which one you should choose, it would all depend on your overall investment goal. If you're looking for more diversification, then you would steer more towards VTI. If you're looking for more of getting a little higher of a return based on previous performance, you will look more towards VOO. However, remember the price difference in each of these. That can make a difference in your decision also. I don't think it would really make sense to own both because you get some of the same companies in VTI that you would get in VOO, just in different allocation amounts. Also, if you're looking into which one you can use for your retirement accounts, it depends on what your company offers, and you may not even have the choice. They may only give you an option of VTI or VOO, or maybe none. If your company retirement account doesn't offer you any Vanguard funds, but you like the concept of a passively managed ETF that covers both the US total market or at least the S&P 500, here are some alternative ETFs that you can research. Charles Schwab's US Broad Market ETF. The ticker symbol is SCHB, and it invests in small to large cap companies and is benchmarked against the Dow Jones US Broad Market Index. This ETF currently invests in over 2,000 of the largest publicly traded companies in the US. It's currently trading around $43, which sounds like a good deal. The next one is the Charles Schwab US Large Cap ETF, and the ticker symbol is SCHX. It's an alternative to Vanguard's VOO. This exchange-traded fund tracks the Dow Jones US Large Cap Total Stock Market Index and gives you access to over 750 large cap companies based on market value, and it's currently trading around $42. Now, if Charles Schwab is not your thing, Fidelity also offers some alternatives to VTI and VOO, but I think their index funds are a better comparison. Fidelity's Zero Total Market Index Fund, FCRX, is a fund that invests at least 80% of its money in companies found in the Fidelity US Total Investable Market Index, and it's designed to reflect the performance of the US equity market and includes small, mid, and large cap companies. This fund is relatively new compared to VTI. It was made in 2018, so it doesn't have a 10-year track record if you're going to look. This fund is interesting though because, as the name applies, it believes in zeros. There are no expense fees for this fund. The fund currently trades around $12, but since it is an index fund, you can only buy it when the price is calculated at the end of the day. Remember, the NAV. With an ETF, the price is always available and you're able to buy and sell it during the stock market hours. If you'd like to learn more about this fund, check out the video we put at the end of this one. If you're looking for a fidelity equivalent to VOO, that would be FXAIX, which is Fidelity's 500 index fund. It invests 80% of its assets into companies found in the S&P 500 index. The fund is currently trading around $124 and has an expense ratio of 0.015%. Again, remember, this is an index fund and not an ETF. Overall, VTI and VOO are both reputable funds. They offer lots of diversification and allow a long-term investor to invest in passively managed ETFs and at the same time get dividends without having to constantly monitor your portfolio or spend time trying to pick winning sectors or winning companies. If you aren't able to invest in VTI or VOO for some reason, the Charles Schwab or the Fidelity equivalents should be on your radar if you're looking for something similar that you can also use in your retirement account or in your regular investment portfolio. If you want to buy all of the funds that we mentioned and don't want to have to open up a brokerage account at each firm, click our link below and open an account with Moomoo. You can find out the details in the description. Now, if any of the terms we used in this video sounded like another language or they were confusing to you and you need them to make sense, check out the description below and download a copy of our 25 must-know investing terms. It's free for you. We made it easy and useful for anyone who wants to learn how to invest in the stock market, but first needs to get over the industry jargon. We think you'll like it, so check it out. And as always, if you like this video, show these twins some love, even though Nicole's not in this video, and make sure you subscribe to the channel and check out the videos we recommended.